Welcome to Trends with Benefits, a podcast by VanEck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to a special edition of Trends with Benefits. I'm your host, Ed Lopez, and I'm joined today by Jan van Eck. And we're doing a special session that's really driven by the whole COVID-19 crisis. It was just last week we held a webinar with Jan and many of our other investment professionals at VanEck. And it was really well received, a lot of great content. And we wanted to distribute that insight in a different format as well. And so I'm going to speak with Jan today and talk about these important concepts that he finds very important and in terms of how to think about what we're going through and his outlook and insights about this. If you'd like to follow along with the slides that he references, this podcast is also available on YouTube, and you can find the video for this podcast on the VanEck channel there. If you'd like to download the slides, you can also visit the webpage for this podcast at vaneck.com/trends with benefits. Jan, thank you very much for joining us on Trends with Benefits.
Ed, it's my honor. It's my first time.
And we get to go over this material again. I mean, you obviously think this is a very important topic, and there's a lot of great content in it.
Yeah, well, we do an investment outlook at VanEck. Often Natalia Gershina, our colleague, will join me. And, just to put some caveats around this, it's basically impossible to predict the markets going forward. So what we try to do is just gather some thoughts that might be a crystallization of some of the research that we're seeing, or something that we think investors should think about that might not be obvious. So so that's what we'll be going through right now.
And so how are you thinking about what we're going through right now? I mean, the markets, the history of the markets have seen many different crises. How does this compare to other things that we've seen, whether it's the financial crisis or the bursting of the tech bubble? How are you thinking about coronavirus today?
Look, generally we like to talk about financial assets, stocks and bonds as being influenced by government action. And it's over the last decade, it's been one song, which is slow global growth and central bank stimulus. Slow growth, central bank stimulus. And it's been the same music that's played. This is really a unique crisis that in my career and may never see again, which is it's a health-driven crisis. So it came out of the blue. It was expected by nobody. But I think that's how investors should be thinking about it as well and framing the time frame. And what I personally think is that we will have not a lot of visibility until mid-April, or pick whatever time period you want. Markets really don't like uncertainty. And so that's why we sort of set a cautionary note several weeks ago when it became clear that this virus was going global.
And so how does this virus now and this crisis, which, yes, it started out as a health crisis, but it's obviously had an impact on financial markets. How does this change your outlook and your view for investment markets going forward?
Well, obviously, we're clearly going through a global recession. And there are some indicators that maybe we can turn to quickly to look at that and to measure that. But commodities have fallen very hard starting in January, which to me reflects the fact that China growth was obviously going to be hit hard. And that slide in copper and oil has only continued as Europe and the US have gotten caught up in it. So we're definitely going through a global recession. The question is the pace of economic recovery after the peak of the virus health impact, the stay-at-home effect. And so, I think that if you think about, before the mid-April period, mid-April and after mid-April, I'm more on the bullish side. I think there's a 20% chance that the markets will have some kind of visibility as to recovery before mid-April. maybe 50% at that time period and 30% afterwards. I think the markets are more bearish than that generally. I think they hit panic mode. And I think many commentators think that there's a 50% chance that even we might not know by mid-April. And they state that in a variety of different ways. They say, well, the health visibility won't be there in mid-April, it'll be in mid-May, or it'll be in the summer, or the virus will come back in China, or there's lots of ways of phrasing that. But I think we'll get a lot more visibility, as I said, through the end of March and through mid-April.
And is that insight and your thoughts on when we'll see maybe the peak part of this driven by what's happening in China, or what's the basis for that outlook?
No, it's basically so I can go forward maybe to some chart here that shows the timeline of events in Hubei province, which is where Wuhan is, and it effectively shows that the sort of time lag between new cases and the lockdown. So as soon as the lockdown started, new cases started stopping, and it took about 2 weeks in China for the cases to peak and then start falling. And what I'm saying is that the lockdown in the U.S., quote unquote, is not as vigorous. So if we say, oh, it'll take 2 to 4 weeks, I'll say, okay, that is taking from mid-March to the end of March, or from mid-March to middle of April. And so that's why I'm really adjusting the China experience to the U.S. and saying that, okay, the U.S. and China are basically the big drivers of the world economy, and that's what I'm focusing on.
And so perhaps we talk a little bit more about China and the economics in China, because that is a big focus of yours and a big part of your expertise. What are you seeing there now in terms of how they're coming out of this crisis and the outlook for China going forward?
Yeah, well, there's a couple of data points, just two, that we think are great in explaining what's happening in China. And the first chart shows PMI, Purchasing Manager Index, and there's basically two lines here. The higher line on this slide is services, and you can see for the past decade that the new China economy has been expanding really consistently over that time period. If 50 is expansionary, the services PMI has been ranging from 53 to 58. Of course, it fell off a cliff disturbingly during the February-March time period. So we're looking forward to a recovery in that statistic. We also look at manufacturing PMI, and coming into this year, there are actually a little signs of hope. It's hard to see on this chart, but the manufacturing PMI has dipped below 50 over the last several years, showing, I'll call it quote unquote recession, or at least slowdown in China. And it was starting to look okay coming into this year, but that of course has been hit hard as well. So I think the way to think about the cycles and the other part of the Chinese economy that's important is the cost of money and interest rates in China. And that's the other chart that we think explains what's going on. And what you can see from this chart here is that there had been a credit tightening coming into 2018, which really peaked. And interest rates in the top line for the private sector had not fallen very much, even though there had been what we like to call a drip stimulus over the last year and a half. So that's the area to watch, I think, going forward as China's economic activity resumes. And I can just give you a quick chart on that. So what this shows is electricity consumption as reflected in coal demand. And what you see is that a month and a half after the Chinese New Year, you're still at something like only 85% of electricity consumption compared to the 2 or 3 prior years. So it's not going to be a snapback if China is a good precedent for the rest of the world. There will be gradual progress. It will be interesting to see if that line is different, but I think that's a line that global investors can benchmark their own expectations against that, maybe it takes at least a quarter for the economy to get back going. And remember, that's when China had the best case in the sense of almost a complete shutdown in the number of new virus cases. So that's kind of the best case scenario.
And so we can look at China as perhaps an indicator for what we might go through, assuming we have that peak cycle in coronavirus new cases in mid-April or so.
Right. And again, it doesn't literally need to be mid-April per se. It's just that we need to have a kind of certainty that that the cases have peaked and that the healthcare system isn't being overrun. Right. So if you look at Italy, for example, just in the last couple of days, or you looked at South Korea before that, I think a lot of people were saying, okay, what's this? Have they peaked and have the new cases started to decline? And is the crisis in a way visibly being improving? Right. That's how I look at it. So it's not the world won't be fixed by mid-April for sure. But financial markets tend to anticipate, and that's why I'm focusing on this period before mid-April in terms of investors setting their expectations.
Will we see other asset classes react? Are there other indicators of economic activity like commodities or emerging markets, things of that sort?
I really like to talk about China and where it's at in its economic cycle. But if you want to look at the global economy, I do think that looking at copper and oil prices are particularly helpful. So again, we're hitting a global recession. Demand for these commodities and the price of it, I think, is a very good indicator of where we're at. You're getting a slightly different story, but I think that's why we combine copper and oil. Copper is known as Dr. Copper because it's such a good economist in telling you where the world is in terms of its growth rate. And you can see here that it didn't really hit the lows of 2015, which is when you had to slow down in what I call old China, and where manufacturing PMI dipped below 50 in China at the same time. Oil, you have a couple of things going on because OPEC is deciding to have a price war at the same time. So it has hit 20-year lows, but I still think that if you see the oil price bottoming, then financial markets will take their cue off of that and say, okay, maybe we've hit the depth of the global recession, because these commodities don't care about the virus. They're just going to be a way of measuring what's going on.
And so how would you characterize what we're going through in the U.S. and U.S. equity markets?
Well, this has been a real sell-off. It's, as you can see from this chart, and I think it's pretty well known by now, this has been the fastest decline in U.S. equity markets, I think, since people have been tracking it. I think there are a couple of indicators that also led me to think that maybe, it's kind of too late to sell. That's what I've been saying over the last week or so. And the reason I say that is because a number of stock market indicators have really hit panic or crisis levels. If you look at, I would say the steepness of the decline is one of those indicators. Secondly, you have the VIX, the index of volatility, and that's hit the highs that we hit pretty much in the financial crisis of 2008, 2009. And then there's another indicator that I like to quote Jeff Sott, who's the former Raymond James strategist. And he says, he counts sell-offs in terms of numbers of trading days. So a normal sell-off lasts 17 to 25 sessions, meaning it would have ended in the week ending on March 20th. Sort of bad sell-offs would end this week, which would be the ending March 27th. And then the worst ever in his career in 56 years would be ending in the week of April 10th, which is another happy data point that happens to coincide with my kind of whole time frame around thinking about this crisis for investors.
So that's just really right around the corner if you think about it in those terms. Are there opportunities now opening up for investors to to target, whether it's U.S. equities or others? How would you advise investors in terms of their portfolio at this point?
I think investors, what I try to do is phrase the question that I think investors need to ask themselves. I don't necessarily want to give them the answer. I'm happy to share our view, but no one, as I said before, no one really knows the future. But what I would say is, I think that if you believe that it's going to be a recession and not a depression, then I think just looking at prior stock market corrections, you've done almost all of the damage. So that's number one. I would say number two, what do you want to buy in general? Just hopefully stick with your asset allocation of equities and fixed income on a globally diversified basis. I think during this panic selling, you did see a couple of things that sort of strike me as particularly distressed. And these would be just tactical observations that should resolve themselves over a period of time. One is, in general, oil at $25 to $30 a barrel is pretty unsustainable, really, for most of the producers out there. So it may not be the asset that recovers the fastest, but I'm just saying that's kind of hit a price point that makes it attractive. I think the other thing I look at is maybe the book value of financials. You had Bank of America stock trade below tangible book over the last several days. That's another one of those things that, whatever you think about financials, that's just, again, a traditional price point where you might want to think about entering. So, those are really, some of the things. Now, you also saw a lot of credit distress from the underlying credit markets, investment grade and high yield, but you also saw that priced into fixed income ETFs. And if you want on an opportunistic basis and you think those credit markets recover, then all of the closed-end funds and fixed income ETFs are kind of particularly attractively priced. But again, that may be temporary as the markets recover.
Now, can I ask you about gold? I mean, that's an important asset class for VanEck, and it has sold off with many of the other assets during this crisis. What is VanEck's view on gold at this point?
Right. So, our general outlook, like I say, in these investment outlooks, we turned positive on gold last summer, the summer of 2019, because we felt that gold had broken out of its bear market. And that's a multi-year chart, which we don't have right here. I think what investors were a little confused about the sell-off in gold bullion and even more so in gold shares during the panic phase of this sell-off. And I think what we'd like to do is compare that price action to what happened in 2008, 2009, which you see at the beginning of this chart, where both bullion and gold shares sold off. But then they recovered really pretty quickly and to a higher degree than the stock market. And what they're reflecting is basically what you're seeing now, which is central banks are throwing the kitchen sink at the financial markets in terms of basically doing everything in their power, expanding balance sheets, easing liquidity conditions. But that will also tend to lead to forces that are positive for gold, higher debt levels and lower interest rates. So we will stick to our positive investment outlook. And like I used to say, if you're ever going to own gold, this is a good time to own gold. Now, there are some investors who don't like it. I understand that, but I do think, and I think another question people had, is it too late? Gold has gone up over the last year. And I think in general, no. If you think that this monetary easing will last for a while to make sure that the world economy recovers, then that should be a pro-gold environment. And indeed, you're seeing gold starting to rally even this week.
Now, from your comments earlier, I take it you're in the camp that we're more likely to be in a recession now and will probably avoid a depression. Is that Did I correctly
Yes.
summarize your view on that? So do you
Yeah.
think that the central banks around the world and the U.S. government is doing enough right now? Do you think more needs to be done to support the economy and the recovery?
I think job one, what I've tried to articulate is that the virus needs to be contained so that if the healthcare steps are inadequate, it really doesn't matter what the central banks do or how much money Congress spends. It really is number one, implementation at the state and local level of these stay-at-home policies and social distancing. That's a lot clearer today, Ed, I think, than it was 2 weeks ago. But that is by far the most important. And if you look at the market reaction to central bank activity, it's been muted. And the reason is because that is not what mattered in terms of ending this recessionary threat. I think to answer your question going forward, I do believe that if the healthcare part of the crisis is solved, then government policy will be enough, and it looks like it's timely and vigorous enough to help businesses and employers get through this sort of gap. It's like a Wile E. Coyote movie, really, where suddenly they're running and then there's no air for a period of 2 months. And as I said, it's unprecedented in my career to see that. It seems like they're taking the adequate steps.
And do you think a solution to the virus is having a vaccine, a working vaccine? I feel like I've heard that could still be a year to 18 months out. Or is it just important to do what we're doing now, which is this whole almost self-quarantine, social distancing, flatten the curve is the term?
Yeah, I guess there's three things I look at. I mean, and I'm far from the expert on this. One is social distancing having an impact? Number one, and then there's therapies which I think are more important to shorter term financial markets and vaccines. I think you're right. In terms of vaccines, it looks like any large scale production, again, this is research that I read through yesterday, is likely to be a year away. They might be able to develop vaccines for healthcare workers, which obviously would be incredibly beneficial within the next 3 to 6 months is a time frame that is based on recent knowledge. So then you get to therapies, meaning are there existing drugs that can help cure people, basically, or reduce the severity of the flu on them? And I don't know, but those will be the three factors. And I guess since I'm on the optimistic side of the scenario, I am thinking that there might be some positive news on therapies that are not priced into the market. And there's a number of different companies. I think probably between 5 and 10 different announcements from drug companies around the world, Europe, the US, and Asia. So who knows who wins the horse race and what's going to be proved efficacious.
There's definitely a lot of effort going behind it now, so somebody's going to come up with something.
Yeah.
What else are you looking at?
Well, I think this is the $64 question right now for investors, right? So I think otherwise to stick to your asset allocation. At this point, again, thinking that the time frame of this is more likely to be near the end of the financial market pain rather than halfway through it.
Oh, that's a good thought to have after all the bad news that we've been getting over the last couple of weeks. It's kind of light at the end of the tunnel view.
Hope so.
Yeah.
Hope so. I mean, I think the key is just to articulate a framework that investors can either say, well, I'm more pessimistic than that, or I'm more optimistic than that. And then what are the signs of a global recession being over? And look, I do want to say, these prices aren't magic, and there will probably be a retest of lows, either of the equity markets, probably the commodity markets. There could be a triple test of the lows. Frankly, there could be new lows. But I'm just saying, you haven't really ever seen this amount of pain without some kind of recovery. And so then you're going to start a different market dynamic, not the pure panic, but a bottoming process.
Jan, well, thank you. That's really insightful information. I think important insights to take into account and to think about going forward. If you'd like to follow Jan van Eck and stay up to date with VanEck insights, please visit vaneck.com/subscribe, and you can find any number of topics to follow and stay up to date with the way we're thinking about things. Jan, thank you very much for joining us today.
Ed, thanks for not being too tough on me.
Well, you're not saying I was too easy, was that?
No, not saying that.
All right. Well,
Next time will be harder, I bet.
All right, good. Thanks again.